Hey friends, it's Tim here, and this week it's like the Super Bowl of economic news. We've got GDP, we've got jobs data, inflation, the Fed, and surprise, an international trade deal just got thrown into the mix. So let's break it all down for you. First off, stocks are ripping once again. Both the S&P 500 and the Nasdaq are set to open at all-time highs once again after news broke that the EU, European Union, and United States reached a trade agreement, and that is pretty big news. Technically, it's not an agreement yet. It's a framework. Still needs to be signed by each EU country, but you know the market likes it. Look what happened to the stock market the minute that news broke. Now, this trade deal is really shaking things up. We've got tariffs on EU goods are jumping from 1.5% up to 15%, and we import about 14% of our goods from the EU. So if you're good at math, that adds up to a 1.9% to imported inflation at the base level. But before you panic, that's not a full 1.9% spike to your wallet. By the time you factor in wholesalers, retailers, and normal markups, most economists expect consumer prices to rise by about 0.2 to 0.3%. So not as big as it might sound. Don't get confused on the tariffs. I think there's a lot of confusion. Even top economists that I hear explain them sometimes kind of explain them differently amongst each other. So big win for U.S. automakers here. The EU slash tariffs on our cars from 10% down to 2.5%. So we could see some more cars sent over to Europe. That has absolutely no impact on my mortgage business, but still interesting. And we are cutting theirs from 27.5% to 15%. Bottom line, the market is reacting. Bonds are under pressure right now. And as you know, we follow bonds closely in mortgages, which means that yields are creeping up. And yes, that affects mortgage rates too. Now, let's talk about this week's U.S. economic data. The GDP report for Q2 is coming out. And Q1, if you remember, showed a 1.6% growth, and this quarter is expected to come in under 1%, and that's a signal of a cooling off economy. And Wall Street is watching closely because slower growth equals less inflation, which equals, wait for it, rate cuts. Eventually. I know we've been saying that for 3 years, but eventually that is going to happen. Now, the JOLTS report, which is job openings, that's expected to show 200,000 fewer openings. Now, that is also significant for a telling story of how our economy is doing. ADP is forecasted at 78,000 new jobs, and Friday we get what is called a BLS report. It's expected at 110,000 new jobs, with unemployment ticking up from 4.1 to 4.2%. So we're seeing a jobs market that's still growing, just maybe a little bit slower. And for the Fed, that's actually good news. Now, are they going to cut rates this week? Most people say probably not. I'm going to go on a limb. I feel like they're going to make a rate cut. I could be the only one. And if you want to call me out for this, feel free to email me or text me an angry message. But I think we could get a cut. Most people say no, but they are meeting and their comments will matter. So it's not always the decision with the rate cut. Sometimes it's the sentiment or the comments that they make. So the market's already betting. We'll see the first rate cut in September according to what the markets are telling us. But again, I think we could see one sooner. Also on Thursday, we're going to get the Fed's favorite inflation number, which is called PCE, not to be confused with PCA, Pete Crow Armstrong, the greatest player in baseball. We'll talk about that on another episode. It's expected to land right between 0.2 and 0.3%, which would be a sign that inflation is softening, but slowly. So what does that mean for mortgage rates? Well, right now, rates have been hovering, as you know, in the mid-upper 6.75 to 7% range for most buyers. If data continues to cool and the Fed leans dovish, we could see a dip in rates heading into August. But here's the thing. If you're sitting back waiting for the perfect rate, and I know we talk about this a lot, just know that when it drops, everyone's jumping in. Demand will spike, inventory will shrink, prices will climb. We've seen it before. So don't chase perfect, chase being prepared. If you're in a stable position and you find the right home, the best time might be before the frenzy. And hey, quick note to my current homeowners. If you bought in the last year and your rate is in the mid or upper sevens, this might be a time to look at a refinance for you now, even before that rate cut. So no promises because it depends on your full picture, obviously, but we've actually had quite a few clients who we've saved a lot of money for lately, people who had that higher rate. So we were able to do some refinances recently. May or may not be time for you, but it's always worth a look. Bottom line, be aware of your options. That's my job, to help you explore the timing and the numbers and what makes sense for you. So if you're ready to talk strategy, whether it's buying, refinancing, or just exploring, shoot me a message. I would love to hear from you. Stay smart, stay steady, and I'll catch you next week.